Hello, everybody. Welcome to another life insurance episode. This is Chad McMahon with Protect with Insurance. This episode is all about mortgage protection tips. Now, first of all, what is mortgage protection? It is, without a doubt, it's a type of life insurance. It's a term policy, which means it does expire at a certain point. The time the clock is going to run out, 10, 20, 30 years typically. It can be 15, it can be 25. There are terms out there that are one-year terms. Don't touch those. One-year renewables are bad news for you. You're basically throwing your money away with those. But with a 10, 15, 20, 25, or 30-year mortgage protection term, you're going to be protected. Your family is going to be protected during the course of that terms. Some of these policies, they give you the option to continue the term at predictable scheduled dollar amounts. It's a huge increase in cost after the term, and you can keep it going. But the idea with these mortgage protection policies is the term life insurance pays off your mortgage, or at least a good chunk of it. It's going to be a fixed amount that you agree to on day one. It's going to pay that off at the end of the term. And the way it accomplishes that is usually upon death, but not always. And I'll get into that here in just another minute or so. Now, with these policies, I'm going to go through about three or four good tips here. The first mortgage protection tip is that level policies are the best type of term policies for mortgage protection. There are three different types out there. There's ascending, which goes up, descending goes down, and level stays the same for the whole term. The reason why level policies are the best, meaning that the coverage doesn't change and the price does not change, is that one, it's a lot easier to budget if you have the same price always. And it's also better because you get today's prices forever. So in another 20 or 30 years, you're still paying 20 prices from 20 or 30 years ago, which is a steal down the road. You know, more money will be coming in then, but this policy is not going to be increasing in cost, so that's a good thing. The other reason why you want to have level coverage, even though the mortgage is going to be going down theoretically, the reason why it's good to keep the same level coverage amount is, let's say your mortgage is $300,000, so you set up a $300,000 policy. In 15 years, you still owe, let's say, 180 or 200,000, something like that, 220. So the way that they handle these policies is your beneficiary receives a check for the policy amount, $300,000. They use that money however they need to or want to. There's no restrictions, and it's tax-free. Okay, they're not going to be taxed on that money. So $300,000, they pay off the mortgage. Let's say, just for easy math, it's $200,000. So they pay off $200,000 mortgage. The rest of that money is just, it's in their bank account. They have $100,000 now to utilize, to live on. And that is going to be a game changer. Having that money is going to make everything so much easier and so much better for your loved ones. So that is how it works. It's very clean, it's very simple, it's very predictable, and it's easy to budget, because if you can budget it today, chances are, tomorrow gets easier rather than harder, because inflation benefits you if you're stuck with the prices of today. So that's when inflation is the only time inflation is a good thing. Otherwise, inflation is terrible. So that's tip number one. Now, tip number two is, it's important to know, a lot of people think they have mortgage protection, but they don't. So unless you set up a mortgage protection policy with a life insurance agent, unless you've done that, you do not have mortgage protection. It's not part of your mortgage payment. It's not what's called PMI, which is private mortgage insurance. It's not homeowners insurance. None of those things are mortgage protection. Your lender, your mortgage broker cannot set you up with mortgage protection. They can only set you up with PMI, which does not benefit you. It's required that you have PMI with most lenders. Conventional loans require PMI to be built in. And so when you pay your PTI, principal, taxes, and interest, typically there's like you've got an insurance payment that's part of that as well. So that's usually homeowners insurance, and usually you're going to have your PMI sandwiched in there as well, especially if you had less money you paid down on your mortgage. So long story short is, mortgage protection, you have to get it through a life insurance agent that does mortgage protection like we do. Otherwise, you do not have mortgage protection. And that's very, very important to know. You got to be real about that. I've had a lot of clients that they were in denial about that. They thought they had it. And so we really looked into it, and they were pretty upset when they realized that what they had was not for them. It didn't benefit them. It was just a requirement, and they were sold some oil skin, essentially. Some snake oil. There we go. They were sold some snake oil. So that's tip number 2. Now, mortgage protection tip number 3. Living benefits are important. So most everyone knows about death benefits. Death benefits that's when you pass away, your loved ones, they receive the benefit of the policy. And that's why most people get life insurance. It's certainly why I got life insurance for myself, so that my wife and boys would be taken care of if something happens to me. But living benefits are different, and they're very important. Living benefits are, I'll give you 3 great examples. 1, you get a terminal health condition. 2, you get a critical health condition. These are all categories of health that your doctors can tell you about, or you call us up, we can tell you about them. Or you get a chronic health condition. Any of these things happen. Chronic is becoming pretty common, actually. But if you get, especially with terminal or critical, then your policy will likely send the entire check while you're alive. So again, $300,000 policy, just for easy math. You get a diagnosis from your doctor, you send in a doctor's letter into the insurance company, and most of these companies, most of these policies, they will send you 100% of that $300,000. They'll send you a check for $300,000. They send it to you, not your beneficiary. And you have that money, use it how you need to use it. Use it medically, use it just pay off your mortgage, save it for a rainy day, give it away, whatever you want to do, you're not taxed on it. There are no penalties, no restrictions. And then the policy ends, assuming that it pays all of it, if it pays 100%. Living benefits are incredibly important. It is so expensive to get sick or to die. It's terrible. It's so expensive when these things happen. And so this is a way for those things financially to either A, be taken care of entirely or largely taken care of. So it's a very, very important thing. There are other living benefits too I'm not going to go into right now, but you can call us, ask us about that. What securities are there in place with the mortgage protection policy to take care of you, to take care of your family? So I hope this has been helpful. Please reach out to us. Go to our website, protectwithinsurance.com. Email us, call us. If you want to see other videos, if you want to see other articles, let us know, and we'll do that for you. We'll put those together for you. All right, stay safe out there.